Hello, hello, hello. Good afternoon, everybody. Starting very promptly today. We had to move back to time just because some other prior commitments. So thank you so much for joining us. It's the holiday season, so we try to do this every week, but during the holidays, things get a little crazy. Last week was Thanksgiving; people are away with their families. So again, thank you so much for joining. We're attempting to do this every single week, and we try our best to keep with that. So here we are with another episode of Mortgage Matters. For those of you who are new to the show, my name is Steven Padernacht. I am a licensed real estate associate broker with Keller Williams in the Bronx. I've been in the business for about, I got my first license in 2005. I was licensed as a salesperson for 2 years, and then I got my broker's license. So in another year or two, I'm going to be in the business 20 years. And in those 20 years, I've seen a lot of different cycles that we've gone through. The one thing that one thing that's been a constant for me that I've heard when I'm talking to people is, Steven, how do I get started? Where do I get started? And it's actually one of the first questions when somebody says that they're interested in possibly buying a home. I say, well, have you gotten pre-approved yet? The first step is we go backwards, and I say, well, tell me, why are you looking to buy a home? And we go through the motivation process. Second to that, I say, well, do you have your finances in order, or have you gotten pre-approved? Have you spoken to a lender? And a lot of times they say no. What tends to happen is people look at the neighborhoods or they look at the homes, and then they realize that, wait a second, I can't afford that home. And then what happens is they get let down. So I always like to start with the end in mind and make sure you know what your budget is prior to searching for homes. So without further ado, I'm going to bring Christian on, who is my trusted advisor, and he could help us kind of walk through the process of getting pre-approved. Christian, how you doing?
What's up, man? How's it going?
Everything is going well. So did you like my my long intro there?
It's good. Yeah. Very good. Looking good.
So were you able to you were able to hear what I was saying, obviously, right?
Yeah. Yep.
How many times do you speak to somebody and they tell you they want to buy a home, but they have not done any of the due diligence? Is that something that happens often for you?
It's every day, because usually, people, agents like yourself are sending your clients to me to do that specific task, so that's what I do, like literally all day long. So most of the people that come to me are first time home buyers. I have repeat buyers also, and we do refinances and things like that. But, most of my business over the last 20 years has been first time home buyers. It's one of the parts of the business that I love the most too, because you're helping families getting to their first home, or you're getting somebody like kind of buying their first kind of investment type stepping stone property to maybe sell later, make some money and buy another home. So it's just more gratifying part of the business, because you're really helping people and you're kind of seeing, people start their financial lives, and buying a home is a big part of that. So, yeah, every day.
How often are they unprepared for what they're actually going to need, or what the bank is actually asking them for to be able to get pre-approved?
That's a good question, because, and I usually start out with my consultation telling people, like, applying for a mortgage is not like any other type of credit you've ever applied for in your life. When you apply for a car, you fill out a one-page form, you fill in, your income, they'll run a credit report, but none of it's verified, so you can basically put it in, write any income you want on a car application. It's mostly all credit based. Credit cards, same thing, one-page application, credit score. You got good credit, you'll get the card. You might not get the card, or you might get it with a higher rate or something like that, but you're still going to get it.
Yeah. Very simple process, right? Like, all right, fill out this form, and we're gonna look at a number on a piece of paper, and we're gonna say, okay, that determines your the amount of money we're gonna approve you for.
Exactly.
Much different than what you do actually for somebody buying a home.
Right. And that's why I start the conversation. I tell them, exactly that. I said, but mortgages are really income based, meaning, on a primary residence, there's, federal laws in place that mandate that lenders have to be able to prove that you can make the monthly payment. So, and we prove that through, normally pay stubs, your W-2s, tax returns. We calculate the income by month. We look at what the proposed monthly payment is going to be for the new place. We look at your other expenses that are on your credit report, and then all of that has to fall within a certain percentage of your monthly income. So I always start out saying, look, the credit score is important. The credit score is going to determine what loan products might be best, what your interest rates are going to be. We could always fix the credit if there's issues on there, especially if we get ahead of it early. But one thing you really can't change is income. It is what it is. Like once we pinpoint exactly what you make and the income we're going to use, that's going to determine the amount. So it's not going to determine whether or not you get it or not. It's going to determine the amount. And that could be, somebody could be, one person might qualify for $500,000, the other person might be $1 million, based on exactly that those income, expenses, and what they call your debt to income ratio.
Yes, there it is, DTI, right?
Right, exactly. So then from there, we look at, you got to have a down payment, you have to have closing costs. There, we have grants, we have first time home buyer programs that can help you with that stuff, but you still will need minimum amount of money to spend to buy a house. So whether it's 3%, 3.5%, VA loans we talked about last time, you can actually do 100% financing, but you're still going to need to spend some money. So when we look at, but that's also going to determine what your end monthly payment's going to be. If somebody has 20% down, their monthly payment's going to be lower than somebody with 3% down.
Which is obviously because they're borrowing less money.
Correct. So I really do like, like putting a puzzle together. Like you have to have all the pieces of the puzzle. You got to have the credit, you got to have the income, you got to have the assets. It's all got to be there, and it's all documented. It's not just verbally, and if it's not documented, that could be a problem later. So it's documented by, bank statements, pay stubs, W-2s, tax returns, like all those things we said, and it all goes into the loan file. So, in terms of your question about preparing for that, for most, you would really want to have prepared your most recent pay stubs, your last year's W-2s, a tax return. If you're self-employed, definitely tax returns for 2 years, ready to go, for when we have that talk. Because if I have those things up front, we can get it done within, a 20-minute conversation, half hour, because it's all there. If I have to start, requesting those things, then it's really back to the person to send me that stuff, and we could be waiting, if they need to send it. So, if you're trying to expedite it, have that stuff up front.
Yeah, when I'm talking to buyers and we're talking about, just like you, I do a buyer's consultation, and I sit with them and I say, okay, so you haven't been pre-approved. So I've been in the business long enough to I can give them a roundabout idea. Say, okay, well, let's tell me, what did you, and I don't even ask them how much money do you make. I said, what did you report on your taxes last year? Okay. Are you still at the same job? The next question, I say, how much assets do you have? Because to your point, assets are so vital, because I tell people all the time that you should, as a rule of thumb, and I know it's kind of old school, but I say, listen, if you're buying a house, you should set aside at least 3 to 5% of the purchase price just for closing costs. And obviously that ranges depending on the type of mortgage you're getting. But so I make sure they have the assets. I make sure that that they're actually filing taxes, or they have verifiable income. And then the third thing is obviously the credit. And it's funny because just like you said, you go to the car dealership, they're asking about your credit first. And really for mortgages, it's the last thing. I just assume, I'm like, okay, so you have good credit, right? And they're like, well, this, and then I kind of start steering the conversation. If I find out they don't have good credit, is I say, okay, well, let's figure out a plan before you even go and go down this road. Let's figure out a plan to get your credit fixed. Because a lot of people now have Credit Karma. They have all My FICO, all these different things. Most of the credit card companies, they give you your credit score on a monthly basis, so you can kind of know where you stand.
Right. But you'll have an idea of a range. It's never going to be the exact when we pull it, because there's all different models of credit scoring, and that's maybe even a discussion for a future weekly call. But right, and to that point, and I tell people too, like, credit can always be repaired. Assets you can save more money. So if it's a matter of saving more money, maybe you're not ready to buy now, but you're ready to buy 3-6 months from now. Income is really the only thing that we really can't change. So, but to get to a higher mortgage, you can certainly pay down some expenses. If people have high interest credit cards, if they have a big car payment, or, a loan, so that we can get that ratio down by having them pay things off over time, and at the same time, hopefully saving, so, which is why one person might be ready today, another person might be ready in 6 months, but it's never too early to at least get the information. I'm always happy to talk to people, even if they don't think, I've talked to a million people that actually don't think they're ready, and they actually are.
Maybe.
Like when they don't know, because a lot of people actually still think you need 20% down to buy a house. It's, and you just don't, and they don't realize that until they get the information. So it's never a bad idea to at least have that consult, see where they are, and see if we can move forward, sooner rather than later.
Yeah. It's funny. I always use this line when I talk to buyers, and I surely didn't make this up. I don't remember where I got it from, but I said, if you're planning a vacation, you're not going to plan a vacation for next week. You're going to plan a vacation for 6 months out, maybe a year out. This home buying process is probably the biggest financial decision that you made in your entire life. You should prepare 6 to 12 months out, so that way you know where you stand and you're able to go and do all of the things that we just talked about to be ready for the process.
Right. Oh, 100% right. Yep.
So I here's another thing, right? I talk to people and they say, I'm pre-qualified. I say, well, hold on. Are you pre-qualified or are you pre-approved? And I asked them to send it to me. So can you tell me a little bit about the difference between when a pre-qualification and a pre-approval?
I mean, technically a pre-qualification can be done, verbally, or just like we were talking before about putting in a stated kind of application without anything being verified. Anybody can kind of just take in information. Like if you tell me, I make X and I have this, then you can run the calculations and say, okay, then you can get, this is the loan you can get. But if it's not verified, it's not really a full approval, because it's really just, and that's happened in the past where somebody says, especially with self-employed borrowers, they don't realize what we actually are looking at. So they'll tell us what their income is, but then when we look at the tax return, it can be very different, So, or people that are paid by the hour. A lot of times I deal with a lot of, first responders, nurses, healthcare professionals that make a lot of overtime. So, there's different ways that we have to calculate that. It's all got to be line itemed out. So if somebody says, oh yeah, I made, $100,000 last year, they might not necessarily be on track to do that again this year. We have to average the overtime, so that could get actually cut down a little bit. So if it's really just done verbally without verification, it might not be a great approval.
So it's really that underwriting process, or actually checking the numbers that people are saying. So I could say, Christian, look, I made 250K. I'm making 250K right now, and ask you to give me some sort of a pre-qualification, but that's not verified. It's not necessarily pre-approval.
And that's why it's dangerous. And, and a lot of times we see there's a lot, there are online lenders and online companies, and won't mention names, but you can basically just put the stuff, you don't even talk to a person and you can get a pre-approval, and it'll say pre-qualification. And you as an agent, if you're taking this person out, you're showing them houses, they're falling in love with houses, they go to make an offer. A lot of times people, because they didn't speak to somebody like me, like they don't even know what the house is going to cost when you finally find it.
Yeah.
So, so even if somebody could get a loan for $1 million, doesn't necessarily mean they want a loan for $1 million.
Yeah.
So that's
another
what
thing.
I do. I always I lead with, what do you think is the most you would want to spend on a loan, including the taxes and insurance? Is that number $3,000, $4,000, $5,000, $1,500, whatever it is? And then I try to work with an approval within that budget, and if their budget doesn't match, like really, isn't in the reality of where they're looking, then maybe they have to look somewhere else. But at least that's where I start. So then when I do send them back to you, you're maybe going to look at 5 houses instead of 100 houses, because we're going to narrow the search. But also when you finally get that deal done, when you finally get that accepted offer, that person's not going to walk away when they find out that it's, $2,000 over their budget. So, so it helps put the deal together. It's managing the expectation from the beginning, and it's going to get you through the end.
I was listening to a podcast recently, and they were talking about the best way to get people, because I guess the best way to manage expectations is kind of just be open and honest from the jump. And tell them, listen, during this home buying process or home selling process, there's going to be certain bumps that we're going to encounter. And I want you to be prepared for these are the potential bumps. And if we tell them that up front, when those things happen, they already have it in their head. So they don't have that shock of like, oh my God, it's over, So like, it's so important. And that's kind of, that's a lot of the reason why I partner with you so much, because you and I both, as we've talked about, handle transactions very similarly. And, you get a lot of these people out here that's like, again, I'm not going to throw any names out there, but you can just go online and just type in, approve me for a mortgage. You're going to get 50 different websites that pop up. You throw some information in there and then they email you a thing. And then they're out here. These buyers are out here looking at homes with this paperwork. And I'm like, wait a second. Let me walk you through and talk to my guy, Christian, before we go out there, because you walk into a house and it's beautiful and you fall in love with it. And then all of a sudden you can't afford it. It's such a letdown that it's really, it's just kind of working backwards.
Right. And I know there's a lot of frustration within the real estate community, where agents that are working their tails off, taking people around, and then the people walk away from the house when they find out how much it's going to cost, so that's why we really got to set that expectation up front. I give you a very specific price range, tax range, what they're going to put down so that person knows. And I even will calculate multiple different payments for that person in the beginning with a range of interest rates, just so they're also not worried about like, okay, if rates go up 1/8 or 1/4% or even as much as 0.5%, I'm still in my budget. So that way we don't have to worry about and I give plenty of room on the approval to make sure that they would even still be approved if rates jump while you're looking.
I feel like the stuff that we cover here is not just geared towards buyers and sellers, but agents as well. Because newer agents just don't know this stuff. And it's like, you get your real estate license, you do the 75-hour course, you pass your school test, you pass your state test, you're so excited, you get your business cards. Now, all of a sudden, somebody raises their hand and says, yes, help me buy a house. And you kind of jump out the window and you go forward with all this stuff without actually knowing that, wait a second, that document that they're showing you is not really what you think it is. And
you'd be surprised how many people come to me with approvals. And or some of the agents, and I tell agents a lot of times too, like all you have to ask somebody is, okay, it's great you have a pre-approval. Did the loan officer tell you how much that is going to cost per month, including taxes and insurance? And did they talk about how much money you're going to need for closing costs? You will be surprised how many people say no.
And
they're running around. I get it. And they're running around with a pre-approval looking for houses, and they have no idea what it's going to cost. That's not a good scenario.
No, not at all. All right, let's assume they go through the home. We have the buyer's consultation. Then you have your mortgage consultation. We get them pre-approved. I've heard horror stories about people being pre-approved, and then all of a sudden they find a house maybe 30 or 45 days later, and something happened. They made a major purchase or something happened. So can you talk kind of do's and don'ts once you're pre-approved?
Yeah. I mean, just like anything else, when we do the pre-approval, if I did a pre-approval 6 months ago, that's somebody's financial picture 6 months ago. So if they're looking for a house in the next 6 months and, they go and get a new car within that 6 months, they didn't have a car payment before. Now all of a sudden there's a $600 car payment on their credit report. That could completely skew the debt ratio calculation, and they might not get that same mortgage that they thought they were getting 6 months ago. So you don't want to really make any major purchases like that, or lease payments or things like that while you're searching for the house, because it will come up later.
No major purchases.
Right. No major purchase, and again, cars, big, maybe, student loans or, kind of necessary, but, and if that purchase is coming up, we should talk about it in the beginning, so sometimes I'll have somebody that has a lease on a car that's coming due. So they likely have to replace the car, so if they had, and lease payments are up right now. So if your last lease was $350 a month, that same exact car might be $550 a month right now. So that's something that we can identify clearly on the credit report. I can see exactly when that lease is going to end. And I have that discussion. Like, okay, this car payment is going to be, are you replacing the car? Are you going to get a lesser car? Sometimes people are turning in the car. They already have another car that they own, so they're not replacing the car. But it's, good to have that conversation in the beginning. And then I'll even tell people, well, if you did end up doubling that payment, you're still going to qualify in this range. Or if you're double that payment, you're not going to qualify in this range, So, and then I can even tell them like, don't get a car payment more than this, So
Yeah,
if you don't want to get that,
yeah.
you don't want to buy the house. Yeah.
Because the major purchases really affect what we talked about earlier, which is the DTI.
Right. Right.
Essentially. Right. And give me an idea, like DTI, from my understanding, DTI for a single family home is the banks look for generally to be under 35%, right?
Well, there's two ratios. There's a housing ratio and there's a total debt to income ratio, right? So there's two numbers. The housing ratio is when we just take the full mortgage payment and divide it into your monthly gross income before taxes, right? That's the one ratio. That ratio should be about 33%. The guidelines say it should be 33%. Now they do allow it to go further, and I find people, my more conservative clients actually they prefer it to be around 25% of their income, especially when they're W-2 salary. They know exactly what they make every month.
Yeah.
I find that people are more happy in that like 25 to 30% bucket, like where they're comfortable. The total debt ratio is when we now take the mortgage payment and add the stuff on the credit report, car payments, student loan payments, credit card payments. That can go on a conventional loan as high as 50% of your monthly income. So when you combine the housing payment plus everything else, you can go to 50%. FHA loans allow you to go to 57%. So there's room in there. But I always even consult my people like, look, you don't want to be pushing it that far if you know exactly what you're making. The reason those guidelines allow it to go far is because sometimes there might be another income in the house, but that's the spouse has bad credit, so they can't be on the application, so they'll allow the one spouse that's on the
yeah, gotcha.
Go higher, because not everybody's cookie cutter perfect, it's going to line up with what they want. So they do allow it to expand, but that's again why I circle back to what's your monthly budget, regardless of what I can get you. What do you want to spend?
What would you like to spend? Where would you feel comfortable?
Right, like on the subject of cars, I use that analogy all the time. I say, if you were going to buy a car, and if you told me I want to get a new car and I don't want to spend more than $600 a month, I'm not going to go tell you. I'm not going to send you to a Bentley dealership. I'm going to send you, to go buy a car where you're going to get a $600 payment. So same idea. If you don't want to spend more than X amount, don't go look at $1 million house. Look at a $500,000 house, because that's what you want to. That's what you want to spend.
I would say, just as a side note, please, anybody who's watching, don't ever walk into a dealership and tell them you want to spend $600 a month, because they will find a way. They will find a way to hammer you, and you'll pay the worst interest or get the worst rate. So don't do that when you're buying a car. But when buying a home,
keep it in your head.
I did that actually. Like my third car. It was the first car I went out and got like on my own. Like where I was like, nah, Dad, I got this. I'm going to go out. I'm going to get the car. And I went and I walked in. I said, all right, I don't want to spend more than whatever, $400 a month. I walked out of that car dealership. I felt so good. I came home. I told my brother. He looked at the paperwork and he's like, you are very, very, very silly because X, Y, and Z. Look how much interest you're paying. Da, 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 da. And then I ended up when that car got beat to the ground, I ended up being over my head, and the car was worth less than what I owed on it, and it was a big mistake. So just a side note.
Well, I mean, there is a huge difference between financing a house and financing a car. Like, there's car dealerships are funny that way. They will literally just show you the payment. Yeah. And that's it. And the funny thing is, when you reverse that in my industry, like everybody, it's the complete opposite. People call me and start asking, what is your rate? And they don't even know what that translates to a payment. They just want to hear a rate. And then when you say like, well, if the rate is here, if it's an eighth better or worse, it's like a $30 difference to your payment. But everybody, and we also have to disclose every single penny of everything that's on there. Whereas car dealerships, literally, I mean, they have, when you sign the paperwork, it's on there. But when you're actually negotiating and everything else, they're just showing you the payment.
The last time I went to a dealership, it was funny because I'm sitting there talking to the person, the salesperson, and we're talking, and I was there with Jen, and it was her doing the car. I was like, no, I'll tell you. And she like went back and talked to the manager, came back, went back, talked to the manager. I felt like I was talking like the Wizard of Oz. Like, I'm like, why don't you tell this guy to come out here and let's just have a conversation?
The secret that I've heard amongst some of my car dealership friends is that there is no manager that they're speaking to. They're usually going to get a cup of coffee. They stop in the bathroom and then they tell you, I just spoke with my manager. But that's not all of them. But that's I've heard that.
Oh boy. All right. So no major purchases. Another thing I've heard is make sure you don't miss any credit card payments, right? Don't miss any payments on
Yeah. You
right?
don't
Because
want
that
that
could
to
drop
pile
your credit score.
Right. Because that's the same thing. Like we renew the credit score. The credit score is not there forever. Like if I did a pre-approval 6 months ago and now you come back, we're going to rerun the credit. And if there's surprises on there, like big payments, but even more so of recent late payment, you can drop a credit score 60 to 80 points with one recent credit card payment. And that can, and there's minimum thresholds for a mortgage. FHA loans, you can go down as low as 520. Conforming loans, conventional loans are 620. If you're at a 619, it's no go. There's no exception to that. So especially if somebody is on that borderline, that's really where we got to be even more sensitive to it. If somebody has an 800 credit score, it's not going to not get them a loan. It might impact their interest rate when we rerun it if it goes down, but it won't necessarily mean they're not going to get the loan if it was very high and drops.
So watch your credit. No major purchases. Anything else that people should be mindful of, like as far as do's and don'ts for once they're pre-approved?
Well, preferably we like to, have an idea of where the money, the assets are, so, if somebody's got money in a 401k and they plan to move it out, I always tell them, call the company, call the who's holding that 401k, find out what the process is, find out if there's penalties, taxes being taken out, and know what you're actually going to walk away with.
Oh yeah, here's a good one. Hey Steve, I've got $100 grand in my 401k. Okay, cool. Oh, 2 weeks later, I can't use that money because they're going to charge me. I'm only going to walk away with 80. So now.
Right. So find that out ahead of time, what you can get, whether it's a loan or it's got to be liquidated, if it's going to be income taxes or, and all, forget that information up front. So, what you can take out. A lot of them allow up to 50%, that you can draw out as a loan, especially if it's still an active account. But if it's an inactive account and older, like that was converted to an IRA or something, you just gotta, you'd have to cash that out, and then they usually take the taxes right out and everything else. So you got to know what your final number is going to be. It doesn't need to be moved out right away, because when you sign a contract, you will need a deposit, but you don't need the full down payment when you sign the contract. But you do still then need that. I've seen trip ups before where people say, all right, the entire down payment's coming out of my 401k. But it was the entire down payment. So now they get to their lawyer's office to sign the contract, and that money's not in an account that they can write a check from. So you got to get that money out sometimes ahead of time, unless you do have some money parked in a checking or savings account that you can at least make a deposit on contract, and then move the money out of the 401k while we're in process.
Yep. Being able to move the funds in a timely manner, because obviously there's paperwork that has to be involved. You gotta call up your employer. Maybe you might need to get permission from your employer, or whatever the case may be. That's a really great point.
But when we start the application, I just need to see where the money is. And then it can be moved while we're in process. But we need to have an idea of where it is, and that it's available. I've had people say like, oh well, I'll have another 20,000 by the time I close. You can't do that. I need to know, because I can't just take your word for it. What happens if, whatever that plan was, what if it falls through, it needs to be a real plan. There needs to be, whether it's a gift from family or whatever else, we need to have an idea of where that money is when we start.
Yeah, and the gift, when you are gifted money, if I'm correct, there also has to be the person who's gifting it to you has to show proof of where it came from. Am I correct? Or do they have to they have to sign a waiver or like some sort of document, right?
It's a gift letter affidavit, which just acknowledges that, I gave my son X amount of dollars for the purchase of this house, and then we get a copy of a personal check. FHA loans require a little more. They will require the donor, the gift donor, to provide their bank statement showing that came out of their account. So there's different guidelines based on the different types of loans, and that's once I'm speaking to somebody and I'm identifying the loan that we're going to go with, I speak more to the specific guidelines of that stuff for that loan.
Yep. Let me ask you a question, and this is kind of this is just off the top of my head, but like, did a lot of these rules and regulations and all the gifting, did a lot of this come from 2007, 2008, like when the or was this always? Or has it always been?
Always been the case. It's fully documented loans have always been there. And that like anytime you were getting a mortgage before the last recession, what changed was a lot of those other mortgage products popped up that were not regulated that allowed for pretty much anything, like,
The stated
right,
loans, right?
right. If a bank or a lender could make up their own product and they were willing, they, were fine at funding that loan, they were able to do whatever they wanted. So that's where the stated and the no income verification and all the craziness went on. So, being in the business, I mean, I started in 2002 at a bank and always did fully documented loans. So it's the way that I've been doing it for over 20 years. I never really got involved in all the craziness there, proposed prior to the recession and all those products because I was working in a bank, at that time. We just didn't have them. But yeah, I mean, but it's guidelines. The guidelines have been tweaked, modified. Sometimes they'll add one, they'll loosen up another. But for the most part, the debt ratio calculations of credit scoring, it's always been there.
Gotcha. All right. So we've kind of walked through the do's and don'ts. We walked through getting ready for the pre-approval, having the pre-approval, what to do, what to not do. I want to just ask you, are there any red flags? Like, and again, please feel free not to say any names of any companies, but any red flags people should look for when they're talking to a lender and the lender is like, hey, don't worry about it, I can get you pre-approved. Is there any sort of red flags that people should be aware of?
I mean, it's really hard to say because, people trust that when they're speaking, to somebody that they're a professional. And, unfortunately, there are a lot of non-professionals in the industry, but red flags are like what I was saying earlier, like have a clear understanding of if I'm getting pre-approved for X amount of dollars, what is my monthly payment going to be? What property taxes did they use? Because if somebody started looking for a house in the Bronx where average taxes could be $6,000-7,000, and then they just go a mile away and they're in Yonkers, same price house could be $10,000-12,000, and that impacts and that goes into your monthly payment. So, or even if they move from one town to another city or whatever else, like the tax, all the taxes can be different. So knowing clearly what property taxes were used in that calculation, and again, how much the monthly payment is going to be and how much money I'm going to need for this loan with this down payment in total.
If somebody doesn't, here's something I get all the time. I don't want to run my credit. I don't want to run my credit because I'm going to lower my score, so on and so forth. So I'm like, but listen, I get it, right? Like you might lower your score a little bit, but in the long run, if you don't do that now, you might end up getting bit later on, and you might not actually have the credit score that you think you have. Is running credit, first of all, is it a soft or a hard pull?
We can do either one now, so previous to just, in the last year, it was always a hard pull, which meant we pulled all three bureaus. Now we're able to do soft pulls where we'll pull one bureau, and it doesn't list as an inquiry on the credit report. That said, and I've worked with credit repair specialists that have told me this information a million times before, that the mortgage inquiries don't really impact your credit in a negative way. It takes like 1 point off of a score that ranges from 450 to 850. Yeah. So, and if another lender had just run it, within, 15 to 30 days, it's not counted as another inquiry on the new credit report if it's rerun. So you do have the ability to do that because you are expected to shop around a little bit within a window of time. So you're really not hurting it. But I do tell people, look, if your credit is borderline, maybe we do the soft pull, because but it's because I don't want to knock it, down. Even that 1 point sometimes can make a big difference. But if you're in, but usually the people who object the most are the people that have the 800 credit scores. And that's why they have it, which is great. You're being responsible, it's great, but it's not going to hurt it by looking at it.
Yeah. All right. So one thing that I wanted to cover earlier, but just kind of before we wrap up, could you, I know we haven't spoken in like 2 weeks. Can you just kind of anything that we should know about, any sort of recent news that came out, any sort of like highlights as far as like basically this week's mortgage news? Is there something that we should know about right now?
Yeah, well, I mean, this week, the Federal Housing Finance Agency announced that they're increasing their conforming loan limit, which they do, year over year, which means, conventional loan now, across the country will go from 726,200 to 766,500. And that's essentially, a loan that'll be backed by Fannie Mae and Freddie Mac, the two agencies that back, like 90 plus loans, percentage of the loans in the United States. And then in the high cost areas where we are, so in and outside of Manhattan, we got Westchester, the boroughs, You can actually do a high balance conforming loan up to, now it's going to go to 1 million. I'm reading it, 1,149,825, which essentially means you can buy a $1.2 million house with just 5% down in that guideline.
Wow.
So again, going back to the people that really think you need 20% down, you don't. I mean, bigger down payments might help you win a bid on a house, stuff like that, but it's not necessary to put that much down to buy a house. So that's
okay.
And we got a big rate decrease in the last few weeks. Rates, remember in October, we're reached 8%. Now we're down into the low 7s. We're seeing 6s. Which if I said in 2021, you'd probably throw a rock at me if I told you rate was 6s. But we're celebrating it now because they were 8.
Yeah, it's I noticed that. I noticed that the rates are coming down a little bit, and let's just hope that it's let's hope it continues to come down a little while, then stabilize the market for a little while, and just kind of let people digest it instead of all this up and down, because one day you think you could buy the house, the next day you can't, the next day you can. It's a lot of emotional things going on.
Why also you really should be re-upping your pre-approval. I mean, I have 4 months on our approvals, but I'm even advising people to re-up them every couple months because there's been so much volatility in rates. You just want to make, even if it's just a conversation, like, shoot me an email like, hey, where are rates now? Am I still in the same range? It could be good news. Like, I'm giving tons of good news now. Like, rates are down 1%, but if they go back up, we should set that expectation while you're still looking.
Yep. It's amazing how the way it's presented, or the way information is presented, could really impact it, right? Because just like you said, right, like in 2021, rates are 6%. Oh my God, the world's falling. Today in 2023, rates are 6%. Everybody's clapping and.
I remember when I had people that when rates were just starting to hit 3 again because they were in the 2s for so long. That if you even said 3, people are like, oh my God, that's so high. I'm going to shop around. I'm going to go over here. I got to shop now. But it's like, so perspective is an amazing thing.
Yep. All right, listen, Christian. As always, I really, 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 really appreciate your time. I have your contact information. I just put it on the ticker down below. Cool. Anything you want to add before we go?
No, I think I'm good, man. Just obviously give us a call if you have any other questions. You want to take a deeper dive into a scenario. We're always available.
My man. All right. I appreciate you, Christian. I'll see you next week. Okay.
All right. Thanks, Steve.
All right. Take care.